Four assets, four very different stories, and one question that every investor needs to answer. Before they decide where to put their money, which one actually won? Not which one felt safest. Not which one your parents told you to invest in. Not which one the financial media recommended. Which one actually produced the most real, measurable dollars in your pocket returns over 10 years? Today we are running the numbers, real numbers, from real starting points across these four assets. We are comparing each one honestly, including the risks, the volatility, and the hidden truths, including the things the winning camp never wants to admit about their favorite asset class. By the end of this video, you will have a clear, data-grounded picture of asset performance. Welcome to Crypto Eye Predictor. Subscribe and hit the like button. This comparison is vital. This is one of the most important financial comparison videos we have ever made. Let's start. Nothing in this video is financial advice. Always do your own research before investing. To make this fair, we are going to use a simple, clear baseline for our comparison. Imagine you invested $10,000 in each asset class at the start of 2015. We are going to track that investment through to the present and see what it became. We are using January 2015 as our starting point for a full 10-year window. This period includes bear markets and bull markets, ensuring no single period unfairly favors one asset. We also look beyond just the final number. We will discuss volatility, accessibility, and liquidity. Because return numbers alone do not tell the full story of holding an asset for a decade, let us start with the traditional benchmark of investing performance, the stock market. Specifically, we will use the S&P 500 index as our measure for this comparison. It represents a broad basket of the largest U.S. companies and is the standard benchmark. In January 2015, the S&P 500 was trading at approximately 2,000 points. As of early 2025, it trades at roughly 5,500 points. That's a huge gain. That represents a price gain of approximately 175% over 10 years. But stock investors also receive dividends, typically around 1.5 to 2% annually. Factoring in dividend reinvestment over 10 years, the total return was approximately 230%. Your $10,000 investment in 2015 would have grown to approximately $33,000. That is a strong return by any historical standard. The S&P 500 delivered well. It delivered these returns with relatively manageable volatility compared to other assets on this list. The biggest single-year drawdown was around 20% in 2022, painful but survivable. The downside? Stocks are subject to corporate risk, regulatory risk, economic cycles, and inflation. The downside? Stocks are subject to corporate risk, regulatory risk, economic cycles, and inflation. And a $33,000 outcome, while solid, is far from life-changing for many. It's important to understand what drove these stock returns. Over the last decade, a handful of tech giants dominated the market. Companies like Apple, Microsoft, and Nvidia saw unprecedented growth, pushing the entire S&P 500 higher than traditional sectors. This created a concentration risk. If these few tech stocks falter, the entire index feels the pain, as we saw during the 2022 correction. During that year, rising interest rates hit growth stocks hard, reminding investors that the stock market isn't a one-way street to wealth. However, the rise of low-cost index funds made it easier than ever for the average person to participate in this growth without picking individual winners. One of the biggest mistakes stock investors make is trying to time the market. The last decade proved that time in the market beats timing the market. Emotional selling during minor dips often leads to missing the biggest recovery days, which can decimate long-term returns. Consistent, disciplined investing through dollar cost averaging was the real secret to capturing that $33,000 outcome. Real estate has been the primary wealth-building vehicle for the middle class for generations, and its performance over the last decade has been genuinely impressive to most observers. By early 2025, it had risen to over $420,000, nearly doubling. The U.S. median home price in January 2015 was approximately $215,000. By early 2025, it had nearly doubled. But real estate rarely works like stocks because of leverage. Most investors use a mortgage. Imagine putting down 20% and borrowing the rest. This changes the return math entirely, and that is before accounting for potential rental income if the property was rented out. However, real estate also carries costs. Property taxes, maintenance, and insurance can reduce actual returns. In some markets, landlord regulatory environments have also created significant challenges for many investors. The realistic net return for a $10,000 investment was probably between 3 and 5 times. assuming you could find a property to buy with only $10,000, which is unlikely. Real estate is also highly illiquid. You cannot sell 20% of your house easily. Transaction costs alone, typically 8 to 10%, eat significantly into your final returns. Your $10,000 real estate investment scenario would have produced somewhere between $30,000 and $50,000. The fuel for the real estate boom was historically low interest rates. For years, money was cheap to borrow. This cheap capital allowed buyers to bid up prices higher and higher. But that changed abruptly in 2022 when the Fed began hiking rates. We now see a locked-in effect, where owners with low-rate mortgages refuse to sell, leading to low inventory and stagnant markets. Returns also varied wildly by region. Markets like Austin or Miami saw far higher gains than rural areas or declining urban centers. For those without a down payment, real estate investment trusts, or REITs, offered a way to gain exposure with much less capital and more liquidity. Many investors underestimate the burden of active management. Real estate isn't passive unless you pay someone else to handle the headaches. When you need cash fast, real estate is a trap. It can take months to sell a property, and forcing a quick sale often means taking a massive haircut on price. Gold has been a store of value for thousands of years and is a classic hedge. Your $10,000 investment in gold in 2015 would have grown to $21,600. In January 2015, gold was trading at approximately $1,200 per ounce. As of early 2025, it trades at over $2,600 per ounce. And its performance, while positive, significantly underperformed stocks and was obliterated by crypto. Your $10,000 investment in gold in 2015 would have grown to $21,600. When geopolitical tensions rise or trust in paper currencies falters, investors flock to gold. We saw this clearly during the initial shocks of the 2020s. Physical storage is a real hurdle. If you keep it at home, you risk theft. If you use a vault, you pay monthly fees that eat into your precious 116% gain. Investors today choose between physical ownership and digital exposure through ETFs. Each has pros and cons regarding security, cost, and access. Gold pays no dividends and generates no income. It just sits there, being gold. Gold's primary value proposition isn't explosive growth, it's capital preservation during times of crisis. As we look forward, the question for gold is whether it can maintain its status as the world's premier hedge, or if a digital alternative will take its place. Now let us run the same exercise with crypto. We will use Bitcoin as our baseline. In January 2015, Bitcoin was trading at approximately $270 per coin. By the most recent cycle peak, Bitcoin reached approximately $108,000. At current prices in early 2026, it trades in a range representing still extraordinary gains. Now let us be honest about what that journey actually looked like for an investor. At recent prices, that investment would be worth between $3.1 and $3.5 million. Your $10,000 Bitcoin investment in 2015 would have bought you 37 Bitcoin. That is not a typo. $10,000 into $3 million in just 10 years. Now let us be honest about what that journey actually looked like for an investor. That 70% drop would have been psychologically devastating for almost any investor. Then, it rose to over $2 million in 2021, before falling back to $500,000. To capture the final outcome, you needed to hold through crashes that felt like the end. The growth was exponential compared to stocks, gold, and real estate. But the honest assessment also acknowledges that crypto is dramatically riskier and more volatile. The people who achieved maximum returns had to endure multiple 80% drawdowns without selling. This built-in scarcity is a fundamental part of the investment case, but the cycles also bring extreme emotional highs and lows. Core stability through stocks, inflation protection through gold, and asymmetric growth through crypto. As the market matured, security and custody became easier, but regulatory scrutiny also increased, adding a new layer of risk for investors. While Bitcoin led the way, thousands of other projects failed entirely. The returns we've discussed were only possible for those who stuck to the fundamentals. The biggest risk of the last decade wasn't volatility, it was the cost of inaction and missing out on new opportunities. The last decade was littered with the carcasses of failed exchanges. Not your keys, not your coins became a survival mantra for smart investors. Regulatory crackdowns remain a constant threat. One stroke of a pen from a major government can impact the price and accessibility of these assets overnight. As we enter a new decade, the landscape is shifting. Technology and finance are converging in ways that will create entirely new asset classes. Stocks and crypto are subject to capital gains taxes. If you sold your Bitcoin for $3 million, you'd owe a significant portion of that to the government. Balanced diversification remains the best tool for most people. It's not about being right about one asset. It's about being prepared for any market condition. Smart money uses tax-advantaged accounts like IRAs or 401ks to shelter their stock and even some crypto gains, significantly boosting that final net number. Fear of missing out at the top and pure panic at the bottom are the two most common reasons why people fail to achieve these theoretical maximum returns. Ultimately, the best investment is one that lets you sleep at night while still making progress toward your long-term goals. The winning investors were the ones who could detach their emotions from their portfolio value and stay focused on the underlying data. Use this information to think clearly about where your own money is working hardest for you. It was not even close. The growth was exponential compared to stocks, gold, and real estate. We bring you data-driven content to help you make better financial decisions. Thank you for watching. The people who achieved maximum returns had to endure multiple 80% drawdowns without selling. I will see you in the next one. Remember, past performance does not guarantee future results. Core stability through stocks, inflation protection through gold, and asymmetric growth through crypto. The exact allocation depends on you. But ignoring crypto entirely cost traditional investors a lot. The last decade saw a massive shift from individual hobbyists to institutional giants. The approval of Bitcoin ETFs in 2024 was a watershed moment. As we enter a new decade, the landscape is shifting. Technology and finance are converging in ways that will create entirely new asset classes. Ultimately, the best investment is one that lets you sleep at night while still making progress toward your long-term goals. Use this information to think clearly about where your own money is working hardest for you. We bring you data-driven content to help you make better financial decisions. Thank you for watching. If this comparison opened your eyes, please hit that like button and subscribe to Crypto AI Predictor. I will see you in the next one. Remember, past performance does not guarantee